everybody. We'll get rocking and rolling here. Thanks for joining us for this webinar presented by Quiet Light on 3 pitfalls to avoid when you're selling your online business. My name is Christopher Moore. I'm the Chief Marketing Officer of Quiet Light, and very happy to be here with you today. And you may notice I'm saying Quiet Light as opposed to Quiet Light Brokerage. Last week, we officially rebranded and became Quiet Light to greater emphasize our M&A services above the fact that we're a brokerage. And besides, brokerages all get a bad name. People don't like brokers. We do a lot more than just broker deals. So we see ourselves as M&A advisors more than anything. So I'm really happy with that rebrand. And we've got some really cool offerings coming in 2021 in terms of webinars, downloadable content, things of that nature. Obviously, we hope to be back to public appearances here sometime this year, and we're excited for some of the opportunities that are coming there. So we're really glad to have you along here with us, and we're excited for some of the things that we'll be doing together in the future. And if you don't know, Quiet Light helps entrepreneurs buy, build, and sell their online business for 6, 7, or 8 figures. Big part of what we do is educational. We speak at conferences and we do podcasts. We do earned media placements, things of that nature. We do a lot of guides and a lot of writing, blog content. We work to help founders plan for a successful exit. We were founded in 2006, and we are entrepreneur-led and entrepreneur-focused. We have 12 advisors now. 11 of the 12 have each built, bought, and sold their own online substantial business. I think the 12th is only built and bought, but not sold. So, or maybe built and sold and not bought. I don't remember what the whole thing is, but a very experienced team of advisors on the Quiet Light team. And with us today is one of those very, very talented advisors and one of my favorite people at the company, Chris Wozniak. We affectionately refer to him as Woz. He is a merger and acquisition master, intermediary, and a certified business intermediary. He created and sold his first e-commerce business in 2003. He has, like a lot of us on this call, the entrepreneur bug. He purchased an affiliate marketing site, created multiple content sites, and an Amazon FBA business. He's been there, done that. He's seen it all, and he's going to share some of his expertise with us today. And Chris, if you had a superpower, it'd be eating without getting full. Is that right?
Yeah. It took it. I really thought on that when I slept on it, and that's the one I came up with.
I think it's a pretty good one. What's your favorite thing to eat?
Oh God, it's a tough one. My wife and I talk about that all the time. I would say probably Mexican food, but then you have like a good Thai dinner, so then you kind of fluctuate. But if it had to be every day, I would say Mexican food.
Great, love it. Terrific. So before we begin, Chris is going to do a prepared presentation. We've got some slides to share with you. If you have questions, if anything comes up, go ahead and feel free to pop those into the chat window. You can raise your hand. You can pop those into the Q&A as well. We'll get to those in the order that they're received as best as we can, and with the time that we have allowed. But I really encourage you to bring your questions as they relate to your specific business. I think these are some general overarching things, but everybody's business is different and unique. One of the big benefits that we have at Quiet Light is we have enough advisors that we can really advise you on the particulars of your business, and we encourage you to ask specific questions. So if something comes up during the course of this call, go ahead and pop it into the chat window, into the Q&A, or raise your hand, okay? And I'll remind you to do that as we go along too, but feel free to do that at any point in time, and we'll get to those questions toward the end. All right, so Woz, take it away.
Sounds good. Okay, let me share my screen here. All right, guys. Thanks for everyone for joining here. So the introduction here is the 3 pitfalls to avoid when selling your online business. So let's kind of get into it. So what I did here is the reason I chose these particular pitfalls, I guess, because unfortunately, there's so many pitfalls that you can encounter with every transaction. So what I did is I really tried to be intentional with my selection here. And so these 3 pitfalls are, or hurdles, I guess you could call them, are pitfalls that I've recently encountered. I've encountered them, I've been doing this for 17 going on 18 years. So certain pitfalls and hurdles cycle throughout deals and throughout the years. But these three pitfalls, along with a fourth bonus that we'll talk about here in a little bit, are pitfalls that I've recently encountered. So they're kind of fresh on my mind, and that's why I wanted to kind of talk about them. I also want to kind of drive home the point that these are real world situations. This is not something I Googled or theory or from an academic perspective or anything like that. These are pitfalls that I've lived and worked through with sellers. The next 30 minutes or so as we go through these, please take these to heart, because at the end of the day, avoiding these pitfalls could literally be the difference between reaching the valuation you want, which is one part of it, but it could also be the determining factor in whether you sell your business or not, which is maybe even more important. Let's get into it here. So here are the three pitfalls. Number one, thinking a penny saved is a penny earned. Number two is running your business like you're going to sell. Number three is making yourself irreplaceable. And number four, which is a bonus, is not allowing your advisor to earn their fee. So let's kind of get into it. First, before we kind of dive into the three pitfalls, it's important to understand sellers' discretionary earnings, because it's kind of the basis for valuation along with multiple. So let's kind of dive into sellers' discretionary earnings really quick to just give an overview. And when we talk about sellers' discretionary earnings, we're talking about with your P&L, you've got your gross sales, your cost of goods, your operating expenses, and then your net income. Part of what we do as advisors or intermediaries is we need to find and locate add backs, which are different items that we can add to your net income to determine what your actual earnings are, what earnings are available to a new owner even. So there's really three levels to add backs. The obvious owner benefits are level one, which would include owner's salary, health insurance, retirement contributions, amortization. Amortization would be like, for instance, if you're a business owner and you purchased your website maybe 5 years ago for X amount of dollars, you probably have an amortization expense, which is allocating the cost of that purchase over a certain number of years. So it's what we call a non-cash item, which is why we add it back, because a new owner won't have that same expense necessarily. Once they purchase it, they can amortize it themselves, but it's not a necessary expense. We also have depreciation. Typically, you don't see a lot of depreciation with online businesses. You really see depreciation when there's real estate involved, or maybe machinery or equipment, heavy equipment. You do have situations though in online businesses where you might have depreciation. So we'll kind of get into that in a little bit also. Another level one add back would be charitable contributions and interest expense. Interest expense is essentially when you have a loan on the business, you're able to expense the interest on that. So we always kind of assume a new owner is going to pay cash for the business, and we don't penalize an owner for having that interest expense. Level two add backs would be kind of referring back to owner's payroll or salary, would be the payroll taxes that are associated with that salary. I don't know what the rate is right now, but assume it's like roughly 15%. So the seller's company pays half of those payroll taxes. So you essentially would need to add those back too. And that is forgotten sometimes, which, if you're making a, $100,000 a year, that could be roughly $7,500 in add backs, let's say, at a three or four multiple, that is, you're looking at $35,000. So it's definitely something you need to consider. Other expenses in the level two add backs might be copyrights or trademarks. Obviously, those can be necessary for the business, but they're one-time expenses. So when we're looking at those, we want to try to see what they are. If they're one-time expenses, we add those back because they're not going to be recurring and in the general running of the business from day to day. There's other level two examples would be like travel, cell phone expenses, meals and entertainment, just other miscellaneous things that, vehicles that we would add back. So those are somewhat obvious. You can find those pretty easily. But then level three is where it gets a little more interesting. So dig deep and use math and logic. What that essentially amounts to is there's no um, there's no I guess black and white way to look at level 3 add backs. So for instance, I represented a roofing applicator about 8 years ago. I sold their company. They had about 1.6 million in adjusted EBITDA at the time. And what we realized about 2 weeks into meeting with the seller is he had renegotiated his deal with one of the roofing manufacturers that manufactured the roofing material. It was his biggest manufacturer. Essentially, what happened was he renegotiated the price, and I can't think what it was per unit or per square foot at the time, but it amounted to roughly $400,000 in savings if we were looking backwards. So on the actual P&L, we had an add back for what we called retroactive add back for cost of goods savings. So that his renegotiation with that particular manufacturer realized him about $1.6 million on the purchase price, which I believe we sold that company for roughly $8.5 million. So 1.5 million is 20% of that total value, which is huge. So it's those types of things. Like if you've got a business where you've increased the per unit price that you're able to charge, and you've done that over a certain period of time, and you can show that it hasn't affected your number of units sold, then you can also potentially add that back retroactively. So there's a lot of situations that it takes a little bit of experience, but really digging into the P&Ls to kind of find out what those are. So that's add backs and sellers discretionary earnings, kind of a quick background on that. So a penny saved is a penny earned. What does that cost you? What does that mean? What does it potentially save you? So reducing taxable income is kind of the main point here. It's a huge deal because what it provides you essentially, and this is what most sellers see, is a tax savings of your potential, whatever your potential tax rate is, multiplied by the actual expense. So if your tax rate is say like 30%, a dollar saved or expensed in this case is really not a dollar earned. First of all, it's 30% of a dollar earned. So you gain 30 cents in the form of savings. So let's say you have a business and your tax return showing a gross income of $1 million. Cost of goods is roughly 45%, and your operating expenses are 31%, which would give you a taxable income on the bottom line of $240,000. Let's assume though that the reality is your gross income is $1 million. Your cost of goods is 45%, but your actual operating expenses, without adding anything personal or anything else commingled into that, is 22%. That means that increases the taxable income to $330,000. So when you look at that example, as a seller that wants to expense things and reduce their taxable income, it seems like a no-brainer that, what does it cost you? What does it save you? Well, it's saving you roughly 240,000 versus 330,000, 90 grand. So what have you gained in reality? So if your tax rate is 30% and you've expensed an extra $90,000 for 2 years, kind of artificially, because it's really, those are expenses that don't either have to do with the business or the personal, for instance, you've saved $90,000 times 2 years. So $180,000 times 30%. So over the course of 2 years, you have indeed saved, roughly $54,000, which is a good amount of money, right? So what have you lost over 2 years though? You've potentially lost $90,000 in income at a 3.5 multiple, let's say, which would be $315,000 in value. Okay, so you've gained $90,000 in tax savings, but you may have cost yourself roughly $315,000 in value when you go to sell your business. So it's as it says here, it's a no-brainer. My opinion is you should have your tax returns be accurate and clean, at least within the last 2 years prior to selling your business. People are going to run, sellers are going to run personal things through the tax return all the time. It's the way it goes. But when you get close to determining whether or not you want to sell, you really want to minimize those personal items. And it's a real thing. I represented a material handling company 12 years ago. If you can picture what they did, they essentially were the physical, logistical builders of scaffolding and logistical things of that nature for like warehousing for Walmart, Costco, Uline, those sorts of things. So they obviously had a huge kind of their cost of goods and their labor were obvious expenses in their P&L. And the seller, who actually, he lives 10 minutes from me, still lives here in Dallas. He expensed a home remodel and a lake house remodel through his P&L, basically mostly in 1 year. And it accounted for roughly $1.2 million in expenses through, between the supplies, cost of goods, and the actual labor. And so what that meant was he went from what essentially he was making about 1.7 million in adjusted EBITDA, but his P&L and his tax return looked like he was making 500,000. And so that was one deal that ended up not selling because I couldn't. It was very, very difficult to delineate the personal items that were allocated to his residence and his lake house, and being able to pull that out of the cost of goods and also allocate. How do you allocate labor on something like that when he's got roughly 30 employees, laborers doing work for him, and then he's kind of lumped in this crew that's working on his home and his lake house. And so again, 1 year he saved $1.2 million in expenses, and call that 30%, roughly he saved himself $300,000 or $400,000. But unfortunately, what I think it cost him was being able to sell the company. And it also cost him $1.2 million in value if we were able to sell the company. 1.2 million at a 3 or 4 multiple is $5 million. So it's a huge consideration. All right, number 2 pitfall: running your business like you're going to sell. When you're marketing your business for sale, don't run your business like you're closing the doors. So essentially, what do I mean when I say like you're going to sell? The easiest way to explain that is the opposite of that would be running your business like you're not going to sell. So if you're running your business like you're not going to sell, you're not going to deplete your inventory to zero. You're going to reorder inventory. You're not going to stop running ads, Facebook, Instagram, Google, shop ads, whatever. You're going to continue to run ads. You're not going to stop paying contractors or employees. You're going to continue to pay them. So running your business like you're going to sell, you want to avoid inventory depletion. You want to avoid reducing or halting your ad spend, and you want to avoid discontinuing contractor relationships. And that seems pretty obvious, but very recently, I'm talking about within the last month, I had a Amazon business under contract, under LOI, and from the time we engaged the seller to the time we actually had an LOI, it was probably 30 to 40 days. And then by the time we got kind of 2 weeks into due diligence, we basically had a 2-month lapse from the P&L that I had and the P&L where we were at. So we had 2 months, and unfortunately, this was November. The buyer, obviously, in his due diligence, wanted to look at the most recent months, and November was down roughly 30%. And so I asked the seller, I said, is anything going on with the business? Is there something wrong, or can you pinpoint why the all of a sudden the dip? Because it was pretty consistent from month to month. And essentially what he did was he just hadn't ordered inventory in a month and a half. And in his mind, he was saving cash, which he did save cash, roughly, I think, $10,000 worth. But what he really did is he spooked the buyer. So it's a penny wise, but a pound foolish in that instance. And that's not what you want to do. In this situation, you really want to maintain the business at a minimum, but you want to be growing the business more than anything. You want to instill confidence in the buyer. You don't want to spook a buyer. And the fact of the matter is the business may not sell. So you don't want to leave yourself in a spot where you've damaged your business and you've got to rebuild it, if you're going forward. So this is a really important one. It does happen very often. And I always try to advise my sellers, look, just because we're engaging you and we're going to the market and hopefully we'll sell your company for you, but don't treat the company as if it's already sold. Pretend you're going to continue to run it. If you can, try to continue to grow it and make it that much more attractive, because that's oftentimes growing the company will put the business over the edge. In contrast to the Amazon company I represented, I just closed on a deal with a rustic furniture dropship company, and in very much contrast to the Amazon company, the husband and wife that owned the business, they grew their business, and we had a lot of time because there was an SBA loan involved with that company. So we had roughly 75, 80 days under LOI to get the SBA to close. And so they had a lot of time from the time we engaged them to the time we found a buyer, went under LOI, months passed. And they did the exact opposite of what we're saying here. They increased their ad spend. The return on their ad spend remained consistent. They grew the business. With COVID, they were able to kind of show that COVID bump was, they kind of passed that. And then through September, October, November, they increased their revenue over the previous year by between 25 and 40%. So all that didn't necessarily change the value of the company, but it instilled confidence in the buyer, and eventually went through with the purchase. So it's hugely important to avoid running your business like you're going to close the doors. The third pitfall is making yourself irreplaceable. Are you irreplaceable? Meaning, as a seller, can a buyer come in, you train them, and they can take your place? You want to ask yourself, by any chance, is your face and presence the actual brand? Is your knowledge or talent specific to you? And is it the value generator as far as your customers are concerned? And then also, are all the processes, the standard operating procedures, how you run the business day to day, are those kind of just in your head because you've been doing it so long, you know exactly what you're doing when you wake up in the morning? So you have to ask yourself those questions, because they're real questions. I had a deal that we didn't close on recently. I think we're going to revisit it in 12 months, but it was a 3D printing business, online business, where the seller, he was very personable. He had a lot of charisma. He did, I think, 95 YouTube videos kind of demonstrating 3D printing for his products. And he actually sold the digital files. They created digital files from scratch, and then he would show how those digital files manifested themselves in these digital printing statues and different other things. So very engaging. He had a lot of followers, a lot of views on YouTube, which drove a lot of traffic to his site. It also created a lot of influencer relationships also on YouTube, and he had a good Facebook group that was very involved and passionate about what he was doing. So that's all great stuff. But what ended up happening is a lot of buyers, as they kind of dug in, they began to wonder, is the seller really what is driving? Is the seller the brand, and is that what's driving kind of the value? Is that what's driving the traffic? So these all became concerns and considerations for buyers. So ultimately, we had to strategize on, what do we do to combat that? And this was upfront with the seller and buyers that we had. Like, it was a strategic kind of deal, like figuring out how do we address that. And so what we talked about was, with the seller, if a new buyer were to take over, we would introduce the new buyer as a partner. They would be involved in videos going forward. I don't know how many videos that is, maybe 15 or 20. And then the original seller, starts to wean themselves out of the picture. Same thing goes for Facebook, the groups. I mean, there's really no face involved there, but it's his voice. So it's just a matter of, in that case, it was kind of, looking at the seller's voice, seeing how he was addressing his people, and then trying to replicate that, but at the same time, the buyer having their own kind of voice and presence in these groups. So that's kind of like what we talked about. We talked about an extended training and transition period, which we felt was necessary. So beyond the 30 or 60 days, we talked about it in terms of 6 months, but at a lesser time frame per month. We talked about a kind of a consulting arrangement on top of that, just to try to get buyers comfortable, which we were. We were able to get buyers comfortable. Ultimately, the seller took the business off the market because he saw some opportunities to grow it. So I think we'll be back on the market with it in the next 12, maybe 18 months. But we were at least able to, I think, get buyers comfortable with how to minimize or mitigate the seller being kind of the presence and the face of and the brand of the business. What else do we got here? So this is kind of the bonus. I would say not allowing your advisor to earn their fee, and this happens occasionally. Sellers often are, they've built the business from the ground up, blood, sweat, and tears. Quite often they're type A personalities. And I don't even know if type A personality is the correct nomenclature anymore. There's all kinds of different personality things right now. But the point is that they've built the business. They've invested their life, their money into it. And so when they hire somebody, oftentimes it's hard for them to let go of the reins a little bit and allow the advisor or intermediary to do their job. So why would that happen? My estimation is it's because of a potential lack of trust from the seller and it also from the buyer, but we'll get into that. And so what we have to do as kind of intermediaries is establish that trust. And I think there's a few ways that we can do it. There's all kinds of ways we can do it, but I think some of the most important ways I've listed here, which would be education. With education would be like this webinar or any of the webinars that the Quiet Light advisors have done. It's also when we get on the phone with you during a valuation discovery call, we're always trying to educate. Education is the best way that we can show we know what we're talking about. We can pull off of past experiences. Most of us have looked at probably thousands of profit and loss statements. And so that's hard to recreate. It just takes time and many years of doing this. And with that, we're able to educate sellers on the process, on valuation, on what it's going to look like. It's going to be an emotional roller coaster. It's probably going to be the biggest transaction of your life. So the best thing that we can do is try to educate up front so that there aren't any surprises and that you're comfortable. I think something also that's unique to Quiet Light is we kind of have the ethos, I guess, of helping first. And I think we take a lot of pride in that. Every advisor here seems to, that's kind of their, the way they approach things with any seller. And I think that's evidenced by the fact that, quite often when we talk to a seller for the first time, they may not be interested in selling for 12 to 24 months. So when we're speaking to them, it's not like we want to get the engagement. We got to get the engagement. And then we got to get you sold. It's really coming from a place of always helping first, always advising, trying to help maybe determine not only what their value is today as kind of a baseline, but also looking at what's the projection and what's the path forward. If they have an idea of where they want to exit, what the dollar value is, how do you get there? We can drill down as far as projections go to, even as much as not only prior year sales patterns, but how many units sold per month. We can try to project out advertising expenses and what those might generate from a return on ad spend. We can get pretty granular, but our ultimate job here at Quiet Light is to try to help first. I think something also that's very unique that helps establish trust is online business experience. And although it's not necessary, I don't think as an intermediary, you absolutely do not have to have experience in the business that you're representing and trying to sell. That's really not what we're here to do. We're here to learn about your business, but we absolutely don't know what it takes to run your business day in and day out, usually. But what's unique about, I think, the advisors at Quiet Light, and I'll actually, I think we'll get into this in a couple slides later, but I wanted to shout out to Chuck Mullins because he actually did a cool survey on this, which we'll talk about. But what's unique about Quiet Light is the amount of online business experience we all have as advisors. I think that separates us completely from the market. I myself personally have sold my first just straight up e-commerce site in 2004. And I've since purchased and started content sites. I still own a Amazon private label site that I started in 2015. To be completely honest, I see sellers every day that have private label businesses that I'm just baffled by how well they're doing. I've had a few successes, but as I said to many people here, that I've had way more failures on private label. So I'm always kind of just impressed by sellers that have cracked the code. But the point I'm making is I do understand, and most of the advisors at Quiet Light understand kind of the ins and outs of a lot of these online businesses because they've actually done it. They've as Chris mentioned at the beginning, they've created online businesses, they've bought online businesses, they've sold those online businesses, or any combination of those. So I think that that establishes a lot of trust as well. Longevity kind of goes into the online business experience, but longevity, I mean more so as far as how long have you been selling businesses as an intermediary. Again, the team at Quiet Light is very, very seasoned. I've been at it a long time, going on 18 years now. So that's clearly a way to build trust. And then deals done. What I mean by that is, what deals have you done? How many deals have you done? How many SBA deals have you been involved with? That's important because deals done is just, you end up seeing patterns with buyers and sellers. You understand the emotions that are going to be involved in it. You understand from a financial perspective, the terms of the deal, what you're going to see, whether it's from high net worth individuals, a regular individual buyer, or a private equity group. In this day and age, there's now holding companies that have a lot of money that they need to place. And they all operate a little bit differently, whether they're financial buyers or, say strategic buyers. All these buyers or individual buyers, they all structure deals in different ways. So one of the best ways to understand those structures is to have seen a lot of them. I've seen a lot of LOIs, letters of intent, and offers to be able to kind of compare them and understand them. So that's really important when it comes to developing trust. And then also designations. There are different designations for intermediaries. There's no really licensing, but there are designations that you can achieve, and those I think are important because with those designations come a lot of money that's spent to maintain those designations. There is a lot of online, now online, used to be in person, educational requirements that come with those. And often with some of the designations, you have to have proof of deals done to maintain those on a either annual or biannual basis. So those are important. And I think those should help establish trust as well. So why trust an advisor? Knowledge in the numbers. So it says Quiet Light here is uniquely and eminently qualified team of advisors. We have an open forum for discussion regarding all topics, including potential issues, valuation, the different niches that exist. All this is extremely powerful, which it is. So I mentioned Chuck earlier. He did I guess kind of a in-house survey of the number of years of online experience that our advisors have. And it was pretty remarkable, in my opinion, what the data came up with, which was, I think, correct me if I'm wrong, roughly 230 to 240 years of combined online experience. And that's nothing to say of the amount of experience with as just being intermediaries running deals. And so I think that is just, it's so extremely powerful to think that, you as a seller, if you hire me, I have a network of 11 other advisors that I can tap into with any question that I have. Again, any potential issue, question, whether it's related to value, the niche that we're going in, something with the P&L, anything. I mean, any question with 230 or 240 years of experience, I'm going to get feedback that you can't replicate. You can't Google those questions and get the same response. So I think that it's just so powerful, this team that we have at Quiet Light of intermediaries that you can tap into. And as a seller, just because you're hiring me or one of the other advisors, you're really hiring kind of the team, because we're essentially and most likely going to be tapping into that team with various questions throughout the transaction, not just when we engage you, but as we get buyers and various letters of intent and we work through the deal. It could even be questions about the asset purchase agreement and due diligence. But the fact that we have this team that we can tap into is extremely powerful. Number of transactions. Why trust an advisor? Number of transactions. I've done, over my 17 going on 18 years, probably 120 to 150 deals. And I'm only a small part of the team. There's, I'm sure, multiple advisors on our team that have done more deals, but it really doesn't matter. I know there's intermediaries here that have done more online deals, but it goes to show that we have a database roughly of, I don't know how many transactions that we can tap into. So it helps us inform multiple comparables. So looking at other companies that have sold, what kind of multiples do they have? And that data is proprietary to us because it's in-house. So it's not something we purchased. It's not from a third party. These are data points that we don't have to rely on others for, which I think is also extremely powerful. And then why trust an advisor? We are intermediaries by nature. I think broker, which is something that still gets, I guess, used and thrown around a little bit. I think it was more popular maybe in the early 2000s, but we really represent sellers as intermediaries. Our job is not to sell anybody on anything. It's not to sell a potential seller on our services, and it's not to sell a buyer on a seller's company necessarily. So we're here to advise sellers. We gather information. Once we gather that information, we analyze that information. If we're moving forward, we then kind of prepare that information, put into a package, and then we convey that information to buyers. So we are basically, by definition, an intermediary. And then after that point, our job is to really hold the hand of the buyer and the seller through the finish line, which would be the closing. And I think that's a good way to point that out as you look at the designations that you can earn, such as the M&AMI, which is a Merger and Acquisitions Master Intermediary. There's the CBI, the Certified Business Intermediary. There's also the Certified Merger and Acquisition Professional. So if you look at those, and these are the recognized kind of designations in our industry, they either state that we are an intermediary. They don't state that we're a broker. So it's either that we're an intermediary or a professional. And I think that's an important distinction. And I think that's also why you should trust your advisor, because we really need to be operating as an intermediary and not a broker per se. How can an advisor help a seller? During the engagement, concentrate on running your business as if you're selling. See slide 7, we go back to that pitfall, and allow us to guide you and advise you throughout preparation. So very recently, and I'm still working on this deal, we're not to market yet, I advised a company and advising a company that has been on cash accounting method since their inception. They're roughly, I think, 6 or 7 years old. And not only that, because of their increased demand, they're up roughly 250% over 2019. 2020 ended up roughly 250% over 2019. They kind of saw that growth in April and May of 2020. So they ordered roughly $1.5 million of inventory, which is a lot. Their average ticket order is, I think, $40 or $44 or so. So if you can imagine, on a cost per unit basis, it's a ton of inventory. And so they're expensing that inventory because they're on a cash basis in 2020. So it reduced their net income by roughly $1.5 million plus an additional $300,000 or $400,000 for the inventory that they had already had on hand before that large order. So in kind of working with them, we had them contact a particular company to convert from cash to accrual, which added essentially $2 million in net income or EBITDA to their bottom line. And when you're talking about a company that was already at roughly $3 million in net income in cash, or sorry, they were at $2 million in net income in the cash method. it added $2 million because of converting to accrual, which added approximately at a 5-time multiple because they're at about $4 million in EBITDA or SDE at that point. But just that conversion added $2 million or $10 million in value. So it took a little bit of work. It took about 3 to 4 weeks of digging into their books, getting the information to the CPA/bookkeeping firm that helped them convert. So it was a bit of a headache, but I would say it was worth a few weeks of their time. And I think what they've spent is about $5,000 to create potentially $10,000 in value. I mean, that's massive. How can an advisor help a seller? Also, multiple driven valuation, why that appears simple and why it's really not. So multiple it's a aspect of valuation that you can't ignore. I think probably the most important thing in valuation is getting the seller's discretionary earnings correct. But eventually it also comes back to multiple. And multiple is not a hard and fast rule. You know, you can't say it's 3 times, it's 3.5 times, it's 4, it's 2.75. I like to say that multiples exist kind of on a continuum or kind of a spectrum. And if you looked at a sample of comparable companies, you know, let's say 1,000 of them, what they've sold for, and the average multiple is 3.1, and you're in that same particular niche, it would be doing a seller a disservice, in my opinion, to just say that we can sell your business for a 3.1 multiple, because really there's various aspects, foundational aspects to what drives valuation. And actually, I want to skip forward here. Speaking of that, this gets into what these are called the 4 pillars of online business value. And I think they're really important because on that continuum, these 4 aspects, risk, growth, transferability, and documentation, can kind of move the needle on that continuum for valuation. So if you have 2 companies that are seemingly, you know, if you take a snapshot of them, they both have the same seller's discretionary earnings, they're in the same niche, they look like the exact same company, but company A has been growing at 300% year over year, company B has been declining, then you can look at number 2, growth, and you realize that company A is going to be worth more than company B. So that multiple for company A is shifted up the continuum. For company B, that multiple is probably shifted below that, say 3.1 or 3.2 or whatever you determined was the comparable multiple. Same goes for risk. You know, an example of risk would be company A is 6 years old and company B is a year and a half old. So if you can imagine from a buyer's perspective, the kind of perceived risk is much lower for company A because that business is seasoned. They've been doing it for a while now. Whereas company B is kind of new to the game. They're just at that threshold of kind of 18 months where you want to be. So that also moves that multiple on the spectrum there. Same with transferability. Transferability essentially means how simple is it to transfer the business from seller to buyer. So that's a foundational consideration when it comes to value and moving that multiple. And then fourth, but probably last but not least, would be documentation. Documentation is a critical one. That gets into, again, like we talked earlier just a little bit ago about converting from cash to accrual. Documentation, if we wanted to focus on one aspect of it, would be the financials, the P&Ls. And I can't emphasize enough how important as a seller it is to have good documentation. You know, hopefully you're on QuickBooks or Xero or one of the other online accounting softwares and your books are in order. It makes such a huge difference in due diligence. It makes such a huge difference in establishing trust with a buyer that they can go through and do that. It makes a difference. Documentation makes a huge difference with getting SBA pre-qualified, which is a big one. One thing I would really encourage sellers to do, and this goes back to kind of the original pitfall, would be when you're putting your P&Ls together in your tax returns, really consider what that is going to cost you. Because if we can show on your tax return your actual net income, if it's $330,000, going back to that example, versus $240,000, that $90,000 may be the difference in what an underwriter needs to see in order to lend money to you, or in order to lend money to a buyer to purchase your company. So again, is it worth the tax savings over a year or two, or is it worth the value that that creates, and not only the actual valuation, but being able to maybe potentially get SBA pre-qualified. SBA pre-qualification essentially means that, you know, instead of having a buyer that needs to pay you $1 million for your $1 million business in cash, we open up the pool of buyers because they may only need 20% down. So they may only need $200,000. So if you can imagine the difference in the pool of buyers from roughly, you know, having to have $1 million in cash versus having to have $200,000 in cash, it's a tremendous difference. So that's something to consider. Essentially, that's it. Just to kind of rehash the 3 pitfalls: thinking a penny saved is a penny earned. Number 2 is running your business like you're going to sell. Number 3 is making yourself irreplaceable. And then number 4, the bonus was not allowing your advisor to earn their fee. That's really it. And Chris, I don't know, do I turn the screen back over to you?
Yeah, you can leave those up and we can keep the screen share going, but there are a couple questions coming in. Again, if you have questions, feel free to leave them in the Q&A, drop them in the chat window, raise your hand. We'll be happy to call on you as time allows. We've got about 10 minutes for questions, so I think that's plenty of time to get to some of these. So here's a couple for you, Chris. Regarding the first point, a penny saved is not necessarily a penny earned. Can't you go back into your income statements when getting ready to sell and delete the personal expenses? And that way you can get the deduction for taxes. But when you're selling, you can update the statement.
Okay, sorry, repeat the question as far as.
Yeah, so can you go back into your income statements in QuickBooks and Xero after the fact, after you filed your taxes, and correct those income statements to reflect the personal expenses that you might have expenses for tax purposes, but do them correctly for you know, P&L for, you know, your SD calculation and add backs?
Sure, you absolutely can. And people, you know, don't get me wrong, every single seller almost has some type of add back in their P&L, whether that's personal items, whether it's the normal level 1 add backs like owner's salary. Where I think it gets a little tricky was kind of in the example I gave, where it becomes hard to, as a buyer, were to dig in and due diligence. This is one example. It would be hard to delineate in cost of goods all the expenses, let's say, that this particular seller was running through the business that related to his home remodel or his lake house remodel. And so you have to be very careful, because you potentially lose value that can't be recouped, because it's just so hard to find those expenses and again, separate them from the actual business expenses. That's number 1. But number 2, I think that's important, again, is SBA pre-qualification, which I think is often overlooked. So to go back to that question, can you go back and remove those? The answer for SBA qualification is no, you can't. You cannot, because the SBA and the underwriters are the only time they're really looking at, they look at the P&Ls, but they're really relying on the tax returns, and then they're looking at the interim P&L statement. So those tax returns are filed. They're going to even do a 4506T, which is, they're going to get the tax returns not only from the seller, but they're going to get them from the IRS. And so obviously those are signed, sealed, and delivered. There's nothing you can do. So essentially, if you picture it from an underwriter's perspective with a bank, they're going to go through and see all these expenses, these cost of goods. They have no other choice but to assume those cost of goods are accurate and that they're related to the business. They're not going to spend 3 weeks and go through your QuickBooks P&L line item by line item and try to delineate what's personal and what's not. They'll allow for add backs like owner's salary and things that are obvious, maybe health insurance. Maybe you can point out some other obvious add backs, but other than mainly the level 1 add backs that we talked about, very rarely are you going to get an underwriter. Almost never. You know, I've been involved in roughly 35 to 40 SBA closings in my career, and plenty more that didn't close and weren't SBA pre-approved because of issues like this. So what SBA pre-approval does for you, though, again, is it opens up the buyer pool tremendously. And what that does is it essentially increases the demand for your business. It pushes the value up, pushes the multiple up. So so a couple ways to look at that, but it's really important.
Great. Okay. So next question is, someone writes that they're taking an SBA loan this year. Is that a hindrance to a sale? She says she has not used it but does have a lien from SBA on the business.
Is it a hindrance? No. We always assume as intermediaries that as a buyer, you're going to take the business over free and clear. The sellers understand that. If they have a question about it, we try to educate them up front when we're engaging them. But yeah, a seller is going to pay off any and all liens and encumbrances prior to the transfer of the business. An SBA loan is no different. I don't know if it's what type of loan you might have. If you're talking about like an actual 7A loan or one of the like PPP kind of COVID related loans, it doesn't really actually matter. It can be an equipment loan, like a 504 loan, a loan on the real estate if you had it, for instance. But no, those are all loans and encumbrances would be assumed to be paid off at closing, which is also why we add back things like interest payments and depreciation, those sort of things.
Great, thanks. Gary has a question here. He says he owns an e-commerce site that's not doing much business, doesn't feel like he can sell because it's not generating income, but doesn't have time to develop it either. Is there a market for such a site from someone who could take it over or partner with it to get it to a sellable point?
That's a good question. It's hard for me to answer that just because I haven't seen the site nor the whatever financials this individual may have. But in general, is there a market for a business? Yeah, I think there's a buyer for just about every business. Even companies that are distressed, online businesses that are distressed, have markets. What that market is basically determined by a little bit of what hopefully we can determine, but ultimately it's determined by what buyers are willing to pay for it, of course. So my answer is yes, there's probably a market for it. I don't know what that market would be. If it's small, but you have a good feeling about the product or service that you're selling online, the answer might be going back to help first, which is what we try to do, which would be maybe exploring what the business might look like a year and a half from now if you took a certain path and executed certain steps, and what kind of value that might create. So there's maybe a couple answers to that question, but I think the original answer is, yeah, I'm sure there's a market for it. I just don't know what that value might be yet.
Great. And Gary did pop a URL at least in the chat window for you, Chris. So you can take a look at that at some point. Next question comes from Shiva, who asks, what percentage of deals happen with an SBA loan? I mean, I guess I can answer that question on a Quiet Light basis, like what percentage of our deals last year closed with SBA financing. But I think that, Chris, you'll probably would agree that that's a broader question. Typically in each of the past 2 to 3 years, we've seen 15 to 25% of deals close with SBA financing. A lot of the reasons why that might be is because what Woz kind of described there is there may be something prohibiting SBA approval on that business that's pre-existing, and someone's sufficiently motivated enough to list that at the present time, so that they're not going to go back and do the work that's necessary to get that pre-qualified. So, but in terms of closed transactions, probably about, I'd say in the last year, 15 to 20% of our deals have been, maybe even less. This year is a little bit fewer, but it's in that range. But those businesses do get more offers and they do get higher multiples. So, Chris, do you have anything to add to that?
No, I agree 100%. Like if I'm looking at my own kind of historical, so if I've done somewhere in the neighborhood of 135 deals, let's say, and I think I've maybe been involved between 30 and 40 SBA closings, so that's probably comes out to about the same percentage that you're talking about, Chris. That 15 to 20% range, probably.
Yeah.
Yeah.
Okay. Again, this is going to be a very big range here, I'm sure, but what are recent multiple ranges? We love this question. I mean, I'll jump in before you even answer and say, on the advisor side, we hate multiples because I mean, I think it's a common question that it's fair for people to ask, but it doesn't necessarily speak to all the values that make your business a sellable asset. So where people tend to focus on multiples, we think it doesn't tell the entire picture. But I'll let Chris answer this question. What are some recent multiple ranges on FBA businesses, especially with all the new private equity cash that has been raised? I also assume they differ for different EBITDA ranges, and what are those ranges? So, I mean, this is going to be I don't know if we can answer this like super specifically, but Chris, can you do your best to kind of like tackle that one?
Sure. Well, I think probably number one, when you talk about Amazon FBA businesses, I would think you maybe first need to specify if you're a private label business or what we might call like a FBA wholesaler. I hate that term. They're not wholesalers. We call them resellers, which would be selling popular brands that are already recognizable to the market. But I'm guessing this person is inquiring about private label because he mentioned the holding companies or the aggregators that are out there buying these companies, a lot of them. The multiples, I don't know. As Chris, as you said, it's hard to state an actual multiple, and I think it's a dangerous thing to do. Again, if you go back to the 4 pillars of value, as I was trying to illustrate that multiples move, they're a fluent tool to valuation. They're always moving, adjusting based on certain metrics of the business. I'll say in general, I think, if you look back 2 or 3 years ago and you fast forward to today, I think it's pushed multiples up on private label businesses for sure. I think there is in general, lack of supply with an increasing demand. I think holding companies are growing in numbers. I know we've run that data internally with Quiet Light, so we're well aware of the holding companies that are out there looking for deals and their criteria. So I think it's definitely historically probably couldn't be a better time to own a private label business and try to achieve the highest multiple you can. But you also, when you're talking about multiple, it's also like, what are you comparing apples to apples? Does the multiple, what is the seller's discretionary earnings and how did you come up with it? Have you left anything on the table? Have you missed something?
Inventory in that? Are you
you're including
looking at a multiple on your monthly earnings or your yearly earnings?
Yeah. Is your multiple based on, hey, the seller told me they're going to do 100% more in revenue and income in the next 12 months in the future. So we're basing our value on that. It's really hard to compare apples to apples. So the best we can do is just look at your individual business on an individual basis and determine what we think is a true, reasonable multiple for it.
Yeah, terrific. Leslie follows up the previous question, a few questions back with this follow-up. Sales dipped 16% because of COVID in 2020. Should they wait for the sales to return or start trying to sell now? I mean, what kind of impact is COVID going to have on a buyer's perception of the overall health of a business?
That's a great question, and it's as long as I've been doing this, and I think as long as all the advisors at Quiet Light have been in this industry, we're also experiencing this kind of for the first time. I've never, I've seen in my work history, I've seen different things that have affected sellers, but this is a new one. COVID has been a new one, so we've seen businesses that aren't affected. We've seen businesses that are positively affected. In other words, they've had what we call a COVID bump. And I've personally seen this with engagements I've had, where they've experienced an extraordinary increase in sales from say March through June. But that bump goes away when they normalize. I've also seen plenty of companies that kind of fell off the map because of whatever niche they were in. COVID just killed them. So the question kind of becomes then, how do you try to normalize that artificial bump or that artificial dip? And the answer to that question is, I'm not quite sure. as we all do at Quiet Light, you basically try to be as upfront as you can. That bump or dip's going to be pretty obvious. Even if the business is maintained, you start to get buyers saying, well, is that maintenance really maintenance, or would it have dipped and COVID increased it? So it looks like it's maintained. So there's all these questions. I think in speaking to a couple experts, I was recently involved in the Certified Merger and Acquisitions Professionals program. And one of the experts there was speaking in terms of financial buyers. And it was his opinion that people are going to be normalizing dips or bumps. So in this particular individual's they're experiencing 16% dip in their revenue. I think you can make an absolute case. If you look back, we have historical data to try to recreate that 16% bump, look at however many months that occurred over, whether it's 3 or 4 months, maybe. And you can clearly see that it was related to COVID. Then that could be a potential level 3 add back that we talked about earlier. So it's on a case by case basis, but I think you could make a case for adding that back if you wanted to sell sooner rather than later. The other option is to wait. We're in mid-January now. The other option would be wait 3 or 4 months till you're through that same period that may have dipped you last year, 2020. You're through it in 2021, and you can obviously demonstrate that to a buyer. So you have a couple options there, but I think it would just be a matter of working through it.
And I'll just add a couple things to this, just from my own observations, on kind of this, what we've seen in terms of sales this year. It's going to really depend upon your goals and identifying really clearly what your goals are in terms of if you want to sell for the most amount of money, if that's your clearest goal, then that might impact it a different way than saying your goal is to have the most number of offers or the best deal terms for yourself at your exit. A lot of people, like I was saying, get focused on the multiple or the exit price, and there's so many factors that constitute a successful sale that thinking about those things, what are most important to you in terms of your exit, and then reaching out to Woz or reaching out to another advisor at Quiet Light and saying, how can I get to that goal? So maybe that, while you're weathering that bump, for the next 3 to 4 months, there are things that you could be doing to even, make your business a more attractive asset rather than just waiting out that period. You could be really proactively working on documentation, working on transferability, or any of those other 4 pillars. That's something where an advisor will really selflessly listen to what your goals are for exit and then help you chart a path toward a successful one. Anything to add to that, Chris?
No, I think you're spot on. I think there's every deal is so unique, and there's you have to approach it uniquely. So no, I think you're absolutely spot on.
So yeah, let's real quick. I mean, we're a little bit over time here, but I've really enjoyed the conversation. Thanks everyone for joining us. Chris, if anyone wants to reach out to you and follow up with questions, get a baseline valuation, how can they do that?
Well, I guess simply you can email me. Our email address, which has changed, right, Chris? It would be Woz, WOZ, at quietlight.com.
Correct. Yeah.
So again, taking the brokerage out of there, and the brand is quietlight.com. So Woz at quietlight.com. You can also, quite often people don't use the phone much anymore, but you can certainly call me or text me at 469-233-7856. I find when I'm working with sellers, I love texting. It's an easy way for them to get in touch with me and for me to get in touch with them. One of the things I try to pride myself on is accessibility and promptness in responding. I think it goes a long way to getting deals done. So yeah, those are the 2 ways to reach me, I would say.
Yeah, and further resources are available for a lot of these questions. Some great questions asked today, but there's a lot of resources on our knowledge base on quietlight.com. If you go to the Learn section, there's podcasts, there's posts, there's guides. There's a few videos that are available. We're adding videos all the time, just like this one. This video will be made available on quietlight.com and on our YouTube page into the future. So if you want to come back and refer to anything that was spoken about, you can do that. If you'd like to receive a copy of these slides so that you can kind of refer to them again in the future, please feel free to email me. My email address is christopher@quietlight.com. And we'll be happy to do that. If you have just like a general inquiry, anything that goes beyond this, or Chris, you also do a lot of buy-side stuff. So if people have buy-side questions, they can refer those to you as well. But another email address that you can just send general inquiries to is just inquiries@quietlight.com. So thank you everyone for joining us. Really enjoyable conversation. Chris, thank you so much for doing this. Is your first time? How did we do?
It's the first time what? What'd you say?
It was your first time hosting one of these webinars. How do you feel we did?
Oh, I think you did great. I'm not sure about me, but
no, I think you did terrific. All right.
Yeah.
Thank you everyone for attending. Thank you again, Woz, for presenting for us today. Thank you for your great questions, and we'll see you again in the future. Thanks.
Thanks, Chris. Thank you, everyone.